Welcome to Decay Factor. Today is September 18th on a Thursday, 2025. Let's take a look at the market and our portfolio and see what's happening here. Let's hop over to the market here. We can see that the E-mini S&Ps were up today just slightly again, but nothing completely out of range. We're in the after hours now, so these numbers here may not be accurate. So I'm just going to click on each one so we can look at the chart. Really no big change here to volatility. We did have a little bit of a crush today. We hit a new low. Let's move over here to SPY was up almost 0.5% today after it looked like we were going to have a little bit of a down move. We didn't. And the VIX is down by 0.13%. Let's take a look at everything else. Big movers here. NVIDIA, 3.5% up. IWM, almost 2.5% up. The Q is up 1%. And of course, we talked about the SPY is up nearly 0.5%. Tesla's down 2.16% today, though. So let's go take a look at that chart. It's not really that far down considering the big moves that we had last week or earlier in the week in Tesla. All right, let's hop over to the portfolio. Before we do that, I'd like to just talk about how sometimes as short premium traders, we're going to have days where we're down. And our down moves and our down days sometimes tend to feel bigger than the up days. In my portfolio, and this may be different with you or for your portfolio, but I seem to have steady up days for a long time. I'll have, let's call it 0.05% up, 0.08% up, 0.10% up, very small up days for a really long time. And then I'll get a string of like 0.75%, 0.5% down days in a row. And it can be very discouraging because you feel like, I've been very patient. I've worked all this time and I'm starting to see some of my mechanics pay off. And then within a week, you lose ground. You lose a month or you lose 2 months or in less than that, you can lose like a quarter. It's really easy to get discouraged. And what I would say to that is the one thing that's really important to do is to look less at NetLick and look less at the portfolio as a whole. I get it. We have to look at the portfolio. We have to manage the portfolio deltas. We have to keep our eye on theta. But look at each individual position and think, what is it about this position that's going wrong? And what's my plan of action to get it back on track? Or if it continues to go against me, what's my plan of action? And so I'd like to do that today. I'd like to look at the portfolio through that lens because I've had some positions this last week that have really gone against me, some defined risk, some undefined risk. And I'll tell you, I get less excited about the undefined risk positions going against me, and it makes absolutely no sense. It's counterintuitive because they're undefined risk. But those positions, I know I can manage them. I know that I can roll them into the future. I can keep the same strikes as I want to and just roll them into the future and roll them into the future every single month and just keep collecting a premium on those and then just wait for that underlying to come to me or roll toward the underlying, get a little bit closer to where it is. The undefined risk positions are just, they're different because if they really go against you, you don't have a lot of opportunity there to roll those out for a credit. In most cases, you're going to roll them out for a debit, and at that point, it's not worth it. So you kind of have to cut your ties on those. What you have to remember in those situations with the undefined risk trades, I'm sorry, the defined risk trades, is that those are predefined. Like the probability of being right on those is predefined. It's built into the trade. It's part of the fabric of the trade. So when you put that trade on, you know what your max loss is, you know what your risk is, and you know what your max profit is, and you know what your profit target is, and you know your probability of success. And it's just going to play out that way. So It comes down to a matter of the more occurrences that you have on, the more those exact probabilities are going to play out. That's why it's really important to be consistent. So, when we put on a defined risk spread, for example, if one we put on and maybe it's $100 max profit, a $1 max profit, and then maybe the other one is like a $3 max profit, and then as a result, your buying power is going to be different. Your buying power may be like $200 on one trade, and then like $1,200 on another trade. That's why it's so important to keep your buying power within a certain range or some bounds so that you don't run the risk of your occurrences that you have on not having the opportunity to play out. And maybe the ones that had higher buying power usage are the ones that go against you, and the ones with lower buying power usage are the ones that work out for you. And then, well, you're down in P&L. You have to play for the long game because the probabilities are ultimately going to play out. And you have to tell yourself that as a premium seller, the probabilities are going to play out. You have to play small enough so that you can survive another day and survive another day and survive another day, and then have thick skin so that on those days or on those weeks when you have a down day and you have a down day and you have a down day and then you have a slight up day and then you have another big down day, that you have to remember you have that extrinsic value. You have that value there. And for the undefined risk trades, it's a matter of time. It's a matter of time until you're going to be right, because position prove me wrong. That is the goal, is to make those positions and make those underlyings prove you wrong. And in most cases, they can't, as long as you can sustain and just wait for duration. But if you happen to get scared and you don't have thick skin and a position is down, you're going to take it off at the worst possible time, the absolute worst possible time. And then you're for sure going to lose on it. You're never going to get that premium back. You're never going to get that money back. So I'd like to look at our portfolio through that lens. And so today I'm going to sort by P&L day. Now, these numbers may not look big, but when you add them up, they are a percentage of the portfolio. And when you have a string of these days where your P&L is down in 5 or 6, 7, 8 positions, it adds up. So let's go ahead and look at the portfolio through that lens. And so I'm going to look here at BE first. So sorted by P&L day, you can see $117 down. This is a one lot. I pretty much trade one lots on everything. So this one is down by $1.17 today. Well, let's go look at the options chain here. And you can see that our original credit was $1.43. And we're down almost our entire original credit just in one day, right? So that can be a little disheartening. So what we're going to look at here is let's go to the trade tab let's go to the analysis tab rather first, and take a look at where we're trading here. Now, this line right here, this expiration line, don't really pay attention to that because we've sold premium in here. We rolled out to the next expiration. We rolled the puts up for a credit. We rolled the puts up for a credit. And then we did another roll. And my options chain for this one is just whacked out. Like, I don't know how else to describe it, but that average trade price is not right because I only have 2 legs in this position. You can see it right here on the screen, but it's saying I have 3 legs. It's saying I have the 60, I'm short the 60 put, the 75 put, and the 75 call, which is not right. I'm short the 75 put and the 75 call. So multiple things going on here. We have to ignore the average trade price here, and we have to ignore this P&L expiration line here because we have all these rolls in the options chain. It'd be great if we could pay attention to that P&L expiration if this was a brand new trade and we didn't have a history on it and there were no options chains, but because those are in there, we can't look at that. So the question then becomes, Our strikes here are at the 75 strike, both of them. So it's a straddle. And we go over here and we look at the chart. We can see 75 lands right here. Let's just grab a price tool and let's update it to be 75. We'll go to the coordinates. We'll plug in 75. And we can see this is where we're at. All right. Another thing is we have not rolled any legs in this trade for a debit. So we've only collected more. We've only collected premium in any rolls that we have on this trade. So what does that mean? That means if this underlying comes back to us and hangs out here at 75 until expiration, we're going to be totally fine. In fact, we're going to close it out early because we're going to hit our 50% of max profit of the original credit. We're going to close it out for that. It's very reasonable that this underlying that has just been rallying for what seems like forever will have a pullback. And it will at some point. I mean, that's inevitable. No stock, no underlying just goes up forever with no pullback. So what I need to do here, we're at, and it's important to point out that we're at 29 DTE. At 21 DTE, we're going to roll it out for duration, which we'll likely have to do. And so the question is how do I roll that out? I personally don't like straddles because you're never really going to pin that strike on that straddle exactly when you need it. Now, what may happen is it may come back and float across that zone at the right time and give us an opportunity to close out the trade for our profit target or even a scratch. Like some of these, yeah, we're okay with just getting out. Like, let's break even. Let's not try to make some money off of this one. Let's just try not to lose too bad on this one. But that said, in 8 days, 21 DTE, we're going to spread this one out again and recenter it. And I may do it sooner than that, simply because I get nervous about, come back over here to the chart, this underlying having a big down day and just blowing right past my 75 strikes right here. I mean, let's say that happens. Let's go over here to the analysis and we could see, like right here, we're in this zone. What if it came down here to, let's say 69? Let's go back to the chart. 69 is right here. Right there. Yeah, that's reasonable. Like it could do that easily. And we would have the same problem that we have right now, but on the other side. And we don't want to have that either. So I like to have a range. I like to have my put down in the 16 to 20 delta. I like to have my call up into the 16 to 20 delta. If I can't have that, or if that costs too much, I'm fine with, going a little closer to the 30 delta on both of those. But at the end of the day, I don't want to keep this straddle on too long. I've rolled my puts up to the point where it's straddled and the underlying is still up there. But I really want to get that back to a regular strangle, which then leads us into what we've heard on Tasty, which is buy the guts, sell the wings. And so my mechanics they're not really crisp and clear on when I do that. It's when I become uncomfortable with the move or the velocity of delta associated with a position. So how quickly can this position move against us and really hurt us from a delta standpoint? All right, so I wanted to get all that out in the open. Let's go look at another one. Let's look at Hut. Hut moved against, NVO moved against us. Let's look at this one. NVO moved against us by $91. Now, that feels like a lot, considering theta is, you know, what it is. So what did NVO do? NVO rallied, right? Yep, NVO rallied. NVO was trading around here. What did we close at yesterday? At 58.20. So we closed right around this ballpark, which is a really good place to be on a strangle. So slight move up, didn't even breach the calls. Did not even breach the call. Like, we have a little bit of ways to go to reach the calls, but you can see I'm down $91 today. So we're not even at the point here where we would roll our puts up yet, because the mechanics that I follow say that I don't roll my puts up until my calls are breached, and I don't roll my calls down until my puts are breached. So it's important to remember that a big chunk of my negative P&L for the day is in an underlying that position that I think is doing just fine. Like, then there's nothing I have to do with it. Let's go look at another one. Let's look at HUT. HUT is an inverted strangle. This is one that has been going against us as well. We roll the puts up here. We're inverted now, which inverted, it can be a little misleading depending on how you look at it, depending on what you know about options and risk profiles. We do have this flat top here, but we're also below the line. So there's no way, absolutely no way for us to be profitable in this position as it stands. We're going to have to roll it out for duration. We roll it out for duration. We collect a little bit of additional premium, and maybe we tighten up the strikes a little bit. We'll see how we handle that at 21 DTE. But we start to get this top line here, this expiration line above the middle, above break even. Because remember, we're not going for max profit. This line right here is max profit. We never hit that because we close at 50% max profit. So 50% max profit is going to be, lower down here, somewhere in the 50% range. So this has to get up to break even, plus has to get higher than that so that we have enough room to hit our 50% max profit. All right. So when you break it down by individual position, it's easier to digest and easier to accept a negative P&L day or a string of negative P&L days like I've experienced in the last few days. Let's look at another one. Let's look at Baidu. This one is a vertical short call spread. This one's moved against us. Like, it's just straight up moved against us. And I would expect that we're probably going to lose on this one. But I'll tell you this, we're not going to hit max loss, which is kind of cool. Like, this thing would really have to rally a lot for us to even come close to max loss. Let's talk about like 170 or something. Let's hop over here to the chart. Well, where does 170 lives? Way up here. I'm not saying it can't do it. And once in a while, we're going to hit one that'll do that. But with this, like, how many days and what? 2 weeks? This thing's been above the 3 ATR. 3 ATR can't even keep up with it. I mean, right now is the perfect time to get short Baidu, in my opinion. But I thought the perfect time to get short Baidu was, whenever I got short Baidu 6 days ago. And obviously it wasn't. So, but the probabilities on the setup were where they needed to be. So again, we might lose on this one. We probably will lose on this one. We probably won't be able to roll this one out for a credit. You can see here, everything's a debit. 20 cents, 36 days, 55 cents, 43 days, 60 cents, 92 days. So come 21 DTE, if we can't roll this thing out for credit, doesn't matter where we are. It's going. We're taking a loss. Hopefully we take a profit. I doubt that's going to happen on this one. Doubt that's going to happen. We'd have to have a pullback all the way down into this range. Let's say 120. Let's go to a chart. What are the chances you think that we come down to 120 by expiration? Funny you ask. We can go check. So let's go take a look at table tab. What was that strike? 120 we said. Yeah, 120. Let's go trade 120. Was a, yeah, 120. What expiration is that? October 17, 120. Yeah, it's about an 18% chance that we get down there. So yeah, possible. Yeah, probably not going to happen. All right. Well, enough doom and gloom and lesson for the day. Let's take a look at a couple of the others here that have legs in the money. We'll take a look at these short call spreads here. This one's trading right in the middle here, as Tasty would say, right on the dance floor. So something like this, you might be able to roll out for a credit. We'll have to see how it pans out. We've got a Hut, inverted strangle. We already looked at that one. Chipotle, this is our friend, problem child from weeks back. Let's look at this one. This is one of those short put spreads that went against us. And we made a call here to sell short put against it at 37.5. And it's thankfully decided it's just going to play around in this little sandbox that we built right here. This little sandbox at expiration means we lose. And lose as bad as if we didn't sell that short put down there. So you might ask, on some of these others, why don't we sell a short call up here on Baidu? Can we sell a short call up here? Yeah, we could. The other thing we have to take into consideration is capital commitment in the portfolio. And at these market levels, with the S&Ps at highs, all-time highs, volatility being as low as it is, as a trader, you have to assess the risk. And I think I would be chasing something, maybe trying to defend a defined risk position that I knew the risk going into it already. And then I commit more capital to try to defend a position that I already knew the risk of going in before. And you could say, well, you kind of did that with Chipotle. Well, yeah, I did. But I also did it at a better price. The amount of buying power that I had to use for this short put in Chipotle was an acceptable amount. If I tried to do this in Baidu, I couldn't afford it. I'd have to spread it off again. So really, I'd just be at that point in like the second tranche of a vertical spread in Baidu. And that's not how I trade. I don't put tranches on in multiple tranches of vertical spreads. So hopefully that helps. Let's go to the activity tab, just kind of see what we did today. In BE, we rolled the puts up And in HUT, we roll the puts up. And that's all that we did. I didn't even look at the watch list today. I'm in defense mode right now. The market's at all-time highs. Volatility is low, and I have positions going against me. I'm not trying to be offensive and open up new trades and use more buying power. That's not where my head is right now. My head is defend the trades that we have, manage them in the right way, and we'll be fine. We'll be fine. I want to share this chart that I maintain here, which shows daily portfolio volatility. You can see right here, the zero mark is here. You can visually follow it across the center. I should probably have some kind of marker there. On the upside, of course, these are positive P&L days. And then on anything on the downside of the zero mark is a negative P&L day. On the positive P&L day, you can see our swings are somewhere here around 30%, wrapped around 30% on the bigger days. And then the down days are somewhere wrapped around 25%. And the difference is our profit. The difference is when we look at our P&L for the day, for the week, for the month, whatever our period is, we see that uptrend in our P&L. But then short term, sometimes we don't see an uptrend. And that's what you'll start to notice happening right about here, I would say the first week or two of probably the first week of September. You can see here, I really wish I had a horizontal line here at the zero mark so we could see exactly where it lands. We had a decent down day here, 0.66% down compared to the previous day. So one thing to point out here, it's not even a 1% down move, which is kind of cool. But we did have a down day. And then we had very, very, very small up day, 0.07% up day. And then we had a weekend here. And then we had a 0.2% almost down day. And then we had another 0.46% down day. And then this one looks like an up day, but it's not. It's just the way the chart works. It's also a down day, 0.11%. And then we have another one here. It's a 0.47% down day, which is today. So you can see down day, down day, down day, down day, weekend that didn't do anything, up that doesn't really matter because it's so small, down day. What is this one? Down day, down day. We haven't had a real up day since 9/7. So we're talking 11 days. And we have a weekend mixed into that. So I've been trading for nearly a decade and really seriously trading for several years. And the psychology of a string of down days can really be catastrophic. The psychology of it can be. Not my portfolio. My portfolio looks fine. Like my numbers are down a little bit. Numbers are down to what they were a month ago. I gave up a month of gains in the last week. But did I really? Like the extrinsic value is still there. And we didn't even talk about extrinsic value. But the extrinsic value is still there. So as long as I keep buying power in check and I'm not forced to close positions at the worst possible time, then I don't close my positions at the worst possible time. We stay mechanical. We roll puts up when we need to roll puts up. We roll calls down when we need to roll calls down. We close at 21 DTE If we need to close, if we can't roll those defined risk positions, then we close them. And everything else, we just wait. We just wait it out. It's just like a storm. You wait it out. If the storm came and there's a tornado and thunder and lightning, and right in the middle of the storm, you run out into the middle of it, that's like the worst thing you could do. You wait it out. You wait it out because you know it's going to pass. This isn't even a big storm, but it is a string of P&L, negative P&L days that can really get in your head if you don't keep it in check and have a plan and know that it's going to happen. Like, we know these days are going to happen. But what would happen? What would have happened had I been using 50, 60, 70% of my buying power? I mean, you can multiply the negative P&L by that much. I mean, you'd have to probably multiply the positive P&L also by that much. But that's portfolio volatility that I can't stomach. I can't stomach portfolio volatility that's 3-4% per day. Like, I can't do that. That's not for me. But what I can stomach is portfolio volatility that stays within this range, and you'll see that we haven't even hit 0.75% in a single day. So after you chart this stuff for a while, and I have been charting these things for years, I know that the chances of my portfolio being down more than 0.75% tomorrow is really low. Yeah, it can happen. We can have a really big market move, and it can happen. But right now, I'm short delta. So at all-time highs, if we have a pullback, that short delta is going to help me out. Trust me, it'll help me out on some of these positions that have just rallied beyond the roof. These are things that you have to trade on a daily basis. You have to trade for a while to have peace with something like this. But we know that theta is working in our favor. Time decay is working in our favor. We have positive extrinsic value. We have positive expectancy in the portfolio. And so as long as we can make it another day without being forced to close positions at the worst possible time, we're going to be all right. All right. Well, thanks for watching. And tomorrow we should do a live session, I believe, and trading session. We'll record that and release that, and it'll be more like the previous episodes. But today I felt like it was really important to talk through this stuff. Until then, see you tomorrow.